Hey everyone, welcome back to Accounting Basics. If accounting terms like assets, liabilities, or equity sound confusing, don't worry. Today we're breaking down one of the most important foundations in accounting, the chart of accounts. By the end of this video, you'll understand not only what it is, but also how businesses use it every single day to track money, stay organized, and make smarter decisions. Are you ready? Let's jump right in. A chart of accounts, often called a COA, is simply a list of all the accounts a business uses to record financial transactions. Let's think of it like the table of contents in a book. Instead of chapters, you have categories like assets, liabilities, equity, revenue, and expenses. Every transaction a company makes gets recorded into one of these accounts. For example, if a business buys a computer, that transaction might go into an equipment account. If the business earns money from sales, that goes into a revenue account. The chart of accounts helps business owners answer questions like, how much cash do we have? How much do we owe? Are we actually making a profit? And what are we spending our money the most on? Without a chart of accountants, financial reporting would be a complete mess. Now, let's look at the 5 main sections of a chart of accounts. First, assets. Assets are things the business owns, like cash, bank accounts, inventory, equipment, and vehicles. Let's say that a bakery has $5,000 in the bank and it owns an oven worth $3,000. Both are assets because they provide value to the business. Typical account numbers for assets often start with 1,000. For example, 1010, cash. 1,200, inventory. 1,500, equipment. Okay? Second, liabilities. Now, liabilities are things that the business owes. This could include loans, credit card balances, and unpaid bills. For example, if the bakery borrowed $10,000 from the bank, let's say, that loan becomes a liability because eventually the business has to pay it back. Liability accounts often start with 2,000. For example, 2010 accounts payable, 2,200 a bank loan. Third, equity. Equity represents the owner's share in the business. It's basically what's left after subtracting liabilities from assets. The accounting formula is assets minus liabilities equals equity. So if the bakery owns $20,000 in assets and owes $5,000, the owner's equity is $15,000. Equity accounts often begin with the number 3,000. Examples include 3010 owner's capital, 3020 retained earnings. Fourth, revenue. Revenue is money that's earned from selling products or services. This is the income coming into the business. For the bakery, the revenue could come from bread sales, coffee sales, and catering orders. Revenue accounts usually start with 4,000. Example, 4010, product sales, 4,100, service revenue. The more revenue a company earns, the healthier the business usually is. And 5, expenses. Expenses are the cost of running the business, like rent, salaries, utilities, and advertising. If the bakery pays $2,000 a month rent, that gets recorded as an expense. Expense accounts often start with the number 5,000. For example, 5010, rent expense, 5,100, utilities expense, 5,200, salary expense. Expenses reduce profit, which is why businesses monitor them so carefully. All right, now let's put all of this together with a simple example. Let's imagine you start a small photography business, okay? On day one, you invest $2,000 of your own money into this business. That transaction affects cash, which is an asset, and owner's equity. Next, you buy a camera for $1,200. Now, your equipment increases, your cash decreases. Now, let's say you get a job photographing a wedding and earn $800. That gets recorded as cash increasing and revenue increasing. Finally, let's say you pay $100 for online advertising. That becomes an advertising expense and a decrease in cash. See how every transaction fits neatly into a category? That's the power of the chart of accounts. Why the chart of accounts matters. A good chart of accounts helps businesses prepare financial statements, track profits and losses, make better decisions, simplify tax reporting, and it detects errors quickly. It's basically the foundation of the entire accounting system. Whether you're running a huge corporation or just a small little side hustle, the chart of accounts keeps your finances organized. And the better organized your records are, the easier it becomes to grow your business. Okay, so let's recap, shall we? The chart of accounts is the organized list of accounts used to track a business's financial activity. The 5 main categories are assets, liabilities, equity, revenue, and expenses. Once you understand these 5 sections, accounting becomes much easier to follow. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you don't miss future accounting basics videos. And in the comments down below, let me know what accounting topic you want me to cover next. Thanks for watching, and I'll see you in the next video.